If you think the most dangerous thing in a falling market is bad news, you are already one step behind the market. Bad news is only the spark. What does the real damage is structure. I have watched people spend years learning how to read earnings, moats, products, management teams, and competitive advantages, then get blindsided in a week because they never bothered to learn what happens when the market stops behaving like a place of judgment and starts behaving like a place of forced motion. That is what most people do not understand. They think a sell-off is still a debate. They think the market is still asking, what is this business worth? They think if they have a good argument and a long-term mindset, they can simply stand there and be correct until price comes around to meet them. That is not how these phases work. There are stretches when the market is no longer a weighing machine in the way people like to quote me. It becomes a pressure system, a threshold system, a plumbing system, a chain reaction system. And in that kind of environment, being early can feel indistinguishable from being wrong. Leverage becomes a loaded gun, and a man who has no protocol discovers that what he called conviction was mostly just comfort borrowed from a rising tape. I want to say this as clearly as I can. The next wave of selling in a market like this does not need a fresh economic truth to appear. It only needs a few mechanical conditions to remain in place long enough for one forced seller to wake up the next, and then the next, and then the next. That is how ordinary pullbacks become humiliations. That is how a man with a good portfolio can still behave like a bad speculator. That is how intelligent people get turned into emergency liquidity for machines. When I was younger, I thought most people lost money because they lacked intelligence. Age cured me of that mistake. Most people lose money because they have no operating system for environments that do not reward intelligence immediately. They have opinions, they have narratives, they have favorite tickers, they have hope dressed up as analysis, but they do not have a protocol for what to do when the market falls into a regime where price is being pushed less by thoughtful buyers and sellers and more by rules, thresholds, hedges, liquidity gaps, and reflexive risk reduction. That is the regime I want to talk about. I am not interested in talking to you like a television man. I am not going to tell you to stay calm because staying calm without a plan is just another form of denial. I am not going to tell you to buy the dip because a dip without a structure underneath it is just a falling object that has not finished introducing itself. And I am not going to tell you to panic because panic is what feeds the machine. I want to diagnose the environment the way I would diagnose a business. I want to tell you what kind of system you are standing inside, what kind of behavior that system punishes, and what kind of behavior it rewards. Because the biggest mistake in a period like this is not owning the wrong stock. It is using the wrong identity. A lot of people enter a machine-driven market still thinking like storytellers. They want a reason, they want a headline, they want one clean explanation they can tell themselves at dinner, but the market does not owe you a clean explanation when it is running on mechanical stress. Sometimes the market is not collapsing because investors reached one elegant conclusion. Sometimes it is collapsing because the system crossed a line. That is the first mechanism you need to understand. I call it the threshold trap. In a normal mind, a line on a chart looks decorative. In a mechanical market, a line on a chart can be a switch. There are large pools of capital that do not wake up in the morning and ask whether a business is wonderful. They ask whether price is above or below a trigger. They ask whether momentum is positive or negative. They ask whether the trend has strengthened or broken. Once those answers flip, they do not debate. They move. That is what frightens amateurs, not because the mechanism is mysterious, but because it is indifferent. A machine does not care that you waited 3 years for your entry. A machine does not care that a stock now looks cheaper than it did a month ago. A machine does not care that a company has $80 billion in cash and a fortress balance sheet. If the threshold breaks, it sells. And if the threshold below that breaks, it sells again. When enough of those systems cluster around the same levels, you get what looks to the ordinary eye like irrational speed. It is not irrational, it is rule-based pressure. And the tragedy is that retail investors tend to react to this pressure as though they are still in a conversation. They tell themselves the market is overreacting. They tell themselves the price is now obviously wrong. They tell themselves they are being brave. What they are often doing is standing in front of a conveyor belt and calling it courage. There is a difference between buying value and catching a mechanical downswing before it has exhausted itself. A great investor has to know the difference. The second mechanism is what I call the dealer mirror. This one confuses people because they imagine dealers as neutral middlemen standing off to the side. In reality, when option exposure gets large enough, the people on the other side of that traffic can become forced participants in the move itself. When the market falls and their positioning requires them to sell into weakness, the decline does not just continue, it feeds on its own reflection. Price falls, they sell. That selling pushes price lower. Lower prices require more selling. The mirror does not just reflect the move, it amplifies it. This matters because a lot of men think they can read a sell-off by watching fear alone. They think if fear is high, then the bottom must be near. Sometimes that works. Sometimes fear does not produce a bottom. Sometimes fear produces a mechanism. If the structure underneath the market is positioned in a way that forces more hedging and more selling on lower prices, then what you are watching is not just emotion. It is emotion being handed to a machine and turned into order flow. That is a very different animal. You can talk yourself through emotion. You cannot negotiate with a hedge requirement. You cannot inspire a dealer not to hedge. You cannot post a motivational quote and make a gamma-driven sell program disappear. The third mechanism is the one I respect the most because it hides under the language of safety. I call it the volatility trapdoor. A lot of money in modern markets is not trying to be heroic. It is trying to be managed. It is trying to be compliant. It is trying to protect retirees, insurance pools, annuity holders, model portfolios, institutions with mandates, and capital that was sold on the promise of some version of control. That sounds prudent, and most of the time it is. But prudence has a dark side when it is turned into a formula. If volatility rises beyond certain ranges, large systems are designed to cut risk, not because the manager suddenly became bearish, because the product itself was built to reduce equity exposure when turbulence rises. That means volatility is no longer just a measure of fear. It becomes a trigger for more selling. And that means the market can reach a point where bad price action causes higher volatility. Higher volatility causes systematic de-risking. De-risking causes more selling, and more selling causes worse price action. That is a trapdoor. It feels solid right up until the second. It is not. The man who is unprepared always says the same thing when that trapdoor opens. This seems excessive. He is right. It is excessive. That is the whole point. Mechanical markets are excessive by design because they do not unwind gracefully when too many participants rely on the same definitions of risk. The fourth mechanism is what I call the liquidity desert. This one is simple and brutal. People talk about wanting to sell as though selling is a solitary act. It is not. Every sale requires somebody willing to buy. In calm markets, that requirement is easy to ignore because there is usually enough participation that you can hit the button and feel clever. In stressed markets, you discover that liquidity is not a permanent feature of the landscape. It is weather. When liquidity thins out, price has to travel farther to find the other side of the trade. That means the same size order that would have felt routine a month ago can suddenly punch a much bigger hole in the tape. Now take thin liquidity and combine it with threshold sellers, hedging sellers, and volatility sellers. That is how you get air pockets. That is how the market starts looking less like a staircase and more like a trapdoor in a dark room. A man who has never thought about liquidity thinks this means the market has become irrational. A man who has thought about liquidity understands the market has become fragile. Fragility is not the same thing as falsehood. Price can overshoot without the long-term thesis being dead, but if you do not understand the fragility, you will respond to it in exactly the wrong way. You will either buy too aggressively too soon because you think the decline is obviously silly, or you will panic at the point of maximum ugliness because you mistake a liquidity event for a permanent verdict. Both errors come from the same flaw. You are reading a stress system with the habits of a calm system. The fifth mechanism is the dollar screw. People love to isolate markets because isolation is emotionally comfortable. They want to discuss stocks as though stocks live in a little box by themselves. They want to discuss volatility as though volatility is separate. They want to discuss the dollar as though currencies are a side topic for economists and insomniacs. That is a childish way to look at markets. In periods like this, the dollar matters because a strengthening dollar tightens the whole environment. It changes financial conditions. It puts pressure on other assets. It interacts with volatility. It changes how global capital behaves. It changes where the pain concentrates, and it can help determine whether a sell-off stays contained or starts pulling more machinery into motion. When the dollar strengthens at the same time the tape is weak, You are no longer looking at a simple equity correction. You are looking at a wider stress regime that does not automatically mean a catastrophe, but it means you should stop speaking in the language of casual dip buying. You should stop acting as though every red week is a clearance sale. There are periods for aggression and there are periods for preservation. A mature investor knows the difference. Now, I want to tell you the most dangerous lie people tell themselves in this kind of market. They say, I am a long-term investor. Most of the time, that sentence is not a strategy. It is a sedative. A true long-term investor is not a person who repeats the phrase during a downturn. A true long-term investor is a person whose capital structure, cash needs, position sizing, and temperament were designed in advance so that a downturn does not force him to betray his own horizon. That is a completely different thing. If you need the market to cooperate in order for you to remain long-term, then you are not long-term. You are temporarily untested. The market reveals this to people in ugly ways. It shows them that what they called patience was really just a luxury afforded by rising prices. It shows them that what they called conviction was really just concentration without a downside plan. It shows them that what they called optimism was really leverage in a suit. I have no interest in flattering you about this. A lot of men need to hear the unpleasant version. If a 20% decline in a stock, an index, or a basket of favorite names would make you violate your own method, then your method was fictional. If you are waiting for the market to stabilize emotionally before you decide what kind of investor you want to be, then you are late. Identity has to be chosen before the stress arrives. Now let me tell you how I think about surviving phase 1 of a machine. Driven decline. I do not begin with forecasts. Forecasts are attractive because they make people feel informed. But the market does not pay you for feeling informed. It pays you for surviving reality better than the next fellow. My first job is not to predict the exact low. My first job is to avoid becoming fuel for the process. That means no leverage. I do not care how elegant the thesis is. I do not care how oversold something looks. I do not care how much money somebody on the internet claims to have made using borrowed conviction. Leverage takes a difficult environment and removes your right to be patient inside it. That is unforgivable. I would rather miss upside than surrender my timetable to margin. The second rule is to separate my capital into roles. There is capital meant to endure. There is capital reserved for opportunity, and there is liquidity reserved for life. Most people destroy themselves because they let one pool of money try to perform all three jobs. Then a sell-off arrives, life still demands cash, and they are forced to liquidate the very assets they claim they were buying for the long term. That is not investing. That is improvising under stress. I never want life to force my hand in the market. If my household needs are chained directly to what the tape does this week, then I do not have an investment portfolio. I have a hostage situation. The third rule is that in a machine-driven decline, I buy in layers, not in declarations. Men love declarations. They say things like, this is the bottom, this is crazy. They are giving it away. That language is ego talking. I have no interest in heroic language. I am willing to begin. I am not willing to pretend certainty. So I scale. I buy a little when price gets more reasonable. I buy a little more if the structure improves. I buy more decisively when I see evidence that the forced sellers are losing control. This is important. Cheapness alone is not enough for me in a mechanical drawdown. I want to see the quality of the selling change. I want to see the speed of damage slow. I want to see volatility stop expanding. I want to see the dollar stop tightening the screws. I want to see price reject lower levels with actual participation. I want to see a market that can absorb bad news without immediately converting it into fresh mechanical pressure. That does not mean I demand perfect clarity. If you wait for perfect clarity, you will pay full price. But I do demand evidence that I am moving from pure forced motion territory into territory where human judgment can start mattering again. That is the difference between buying a crash and stepping underneath a demolition. Let me give you the protocol the plain way. If volatility is still expanding, I am careful. If the dollar is still strengthening aggressively, I am careful. If liquidity is thin and price is slicing through thresholds cleanly, I am careful. If dealers are still likely to sell into downside, I am careful. If volatility control type structures are still at risk of reducing exposure, I am careful in plain English. If the machine still has more room to hurt people, I am not in a hurry to prove how brave I am. Bravery is cheap in markets. Survival is expensive. Now, what would make me start leaning the other way? I want to see the machine tire. I want to see the VIX or its equivalent stop behaving like a rising fire and start failing to make new extremes. I want to see the dollar lose some of its urgency. I want to see a day or two where heavy volume shows up and price closes stronger, not weaker. I want to see evidence that a down open does not automatically become a waterfall. I want to see that the market can take stress without expanding the stress. That is when the odds begin to improve. Not because somebody rang a bell and announced the bottom, because the structure is changing. You must understand this distinction. A bottom is not just a price. A bottom is a transfer of control. It is the point where the market moves from forced sellers dominating to willing buyers gaining ground. That is the transfer I am waiting for. Until then, I do not confuse motion with value. This is where I part company with the men who were educated by bull markets. Bull markets teach people to romanticize immediacy. They start to believe that every pullback is a gift and every hesitation is cowardice. Then a genuinely hostile tape arrives and exposes them. They do not know how to wait. They do not know how to preserve ammunition. They do not know how to let a system show its hand. They only know how to press buttons and call it conviction. I have no admiration for that. The real money in markets is not made by acting every day. It is made by acting correctly when the conditions justify action and by refusing to act when the conditions punish impatience. Doing nothing is not laziness when the environment is hostile. Doing nothing can be discipline. Cash is not always cowardice. Sometimes cash is deferred aggression. Sometimes cash is the price you pay for the right to be dangerous later. A man who cannot sit with cash in a mechanical storm usually does not want returns. He wants emotional relief. That desire is what ruins him. Now let me talk about quality, because people misuse that word too. In a stressed market, quality is not simply a stock you liked last year. Quality is not just a familiar name. Quality is not a company that used to go up and therefore feels safe. Quality is balance sheet strength. Quality is cash generation. Quality is a business that can live through slower conditions without begging the capital markets for permission to survive. Quality is management that does not need perfect conditions to justify its existence. Quality is a business that can still matter after the speculators are carried out. When fear is high, I would rather own a wonderful business bought with patience than a dramatic story bought with urgency. That sounds simple. It is simple. But simplicity is often hardest when people are scared, because fear makes complexity feel intelligent. It makes frantic motion feel responsible. It makes overtrading feel like seriousness. None of that impresses me. If I have to choose between owning fewer, stronger things and chasing a dozen weak ideas because they look cheap after a fast decline, I know where I stand. I want what can survive the weather. Now I want to say something to the man who is already down and looking for a way to feel in control. Again, be careful not to turn this kind of environment into a personal redemption project. The market does not know you are embarrassed. It does not care that you were too late to raise cash. It does not care that you bought higher and now feel foolish. That emotional state is dangerous because it makes men reach for speed. They tell themselves they need to make it back. They look for the sharp rebound. They start flirting with shorts. They do not understand leveraged products they cannot control, and oversized bets they rationalize as necessary. That is not strategy. That is wounded vanity. And wounded vanity is a very expensive portfolio manager. There is no shame in slowing down. There is no shame in admitting the market is in a phase you do not fully respect yet. There is no shame in requiring proof before you redeploy serious capital. The shame is in pretending you are calm when you are really cornered. The shame is in calling recklessness courage. The shame is in letting a temporary market regime talk you into permanent financial damage. The reason I speak this way is simple. In every serious drawdown, the largest losses are not produced by information gaps. They are produced by behavioral fractures. People know leverage is dangerous. They use it anyway. People know they need liquidity. They spend it anyway. People know they should not buy because they are bored, ashamed, or panicked. They do it anyway. So I am less interested in teaching you a trick than in telling you the truth about the kind of person this tape rewards. It rewards the man who can delay emotional relief. It rewards the man who can distinguish price from process. It rewards the man who respects thresholds without worshiping them. It rewards the man who keeps a list of what he would love to own, but waits for structure to stop deteriorating before acting aggressively. It rewards the man who knows that buying power saved in phase 1 is buying power multiplied in phase 2. And it destroys the man who needs the market to stop hurting before he can think clearly. That is why I want to give you a blueprint, not a slogan. I want you to imagine your portfolio as a ship entering cold water. Not because I enjoy dramatic metaphors, but because cold water punishes confusion fast. Your first compartment is survival capital. This is the money that keeps your life, your obligations, and your household independent from whatever the market does over the next several months. It is not there to impress anybody. It is there so you do not become a forced seller. Your second compartment is core ownership. These are the durable businesses or broad vehicles you intend to own across cycles because they represent productive assets you actually believe in. These are not for impulsive trading. They are for planned, measured accumulation. Your third compartment is tactical capital. This is where you allow yourself to exploit dislocations. But tactical capital is only dangerous when it is capped. It must never be so large that tactical mistakes contaminate your household or your core strategy. Once you build those compartments, your behavior changes. A sell-off no longer feels like one giant threat because every dollar already has a job. That is how adults invest. Not by improvising brilliantly, but by assigning roles in advance. I also want you to write a protocol for yourself, not in your head. On paper, I would do this if I were you. I would write down what conditions would make me add small. I would write down what conditions would make me add larger. I would write down what conditions would tell me the machine is still in charge. I would write down what position size I can emotionally and financially tolerate if the market falls another 10% from my first buy. I would write down what I refuse to do, including leverage, oversized averaging, or buying based on boredom. And then I would sign it. Why sign it? Because a signed protocol turns a preference into a contract. When volatility rises, men become negotiators with themselves. They keep moving the goalposts. A written contract prevents that. It tells the frightened version of you that the calmer version already made the rules. You do not need more opinions. You need more obedience to your best thinking. Now, I am going to tell you the sentence that matters most. The first goal in machine-driven correction is not to get rich. It is to remain intact long enough to own the rich part later. That is what people miss. They want phase 3 rewards while phase 1 mechanics are still chewing through the system. They want to buy the final low before the market has even decided who must be carried out. They want applause for courage when they should be building the right to endure. That is backwards. In every meaningful cycle, the men who eventually look brilliant usually spent the early phase looking boring. They raised some cash when others were euphoric. They avoided leverage when others were boasting. They accepted that the market could get stupider for a while. They did not need immediate validation. They needed staying power. That is a different temperament. And it can be learned if you are honest enough to admit where you are weak. Maybe your weakness is impatience. Maybe it is the need to call the exact bottom so you can feel smarter than everybody else. Maybe it is the need to always be invested because cash makes you feel irrelevant. Maybe it is the urge to double down just because the market embarrassed you. Whatever it is, find it, name it. Because unnamed weakness becomes repeated behavior. Named weakness can be managed. This brings me to the identity flip I care about most. Most men enter the market trying to be right. The men who endure these phases are trying to be anti-fragile. That is a better ambition. Being right too early can hurt you. Being anti-fragile means building a method that improves as the environment clarifies. It means letting volatility reveal prices, structures, and opportunities while protecting yourself from the part of volatility that destroys the unprepared. It means you do not need to predict the exact path. You need a process that gets stronger as the picture sharpens. That is what I would want for myself. That is what I would want for my family. That is what I would want for any young investor who has been miseducated by easy years. Before I finish, let me tell you what I would not do. I would not chase every bounce because short covering rallies are violent and seductive. I would not assume one green day means the stress regime is over. I would not blindly average down in speculative names just because they are far from their highs. I would not listen to anyone whose method begins with certainty and ends with an affiliate link. I would not confuse entertainment with guidance. And I would not build a portfolio that requires the market to be kind in order for me to stay solvent, patient, or married to my own decisions. I would also not let fear make me miss the real lesson. Because this phase, ugly as it is useful. It reveals which businesses are truly strong. It reveals which investors were only brave in warm weather. It reveals how dependent the modern market has become on threshold behavior. And it gives disciplined people a chance to study the plumbing instead of worshiping the wallpaper. You do not need to love this environment, but you do need to learn from it. Because once you see how these machine phases actually work, you stop personalizing them. You stop reacting like every downdraft is a moral judgment on your intelligence. You stop believing every bounce is a rescue boat. You stop arguing with the tape and start studying what kind of regime you are in. That change alone can save you a fortune. I want to leave you with a final test. Stand in front of the mirror and ask yourself one question. If the market dropped another 15% from here, would I behave according to a plan or according to pain? Do not answer quickly. Answer honestly. If the truthful answer is pain, then your job this week is not to find the perfect trade. It is to write the protocol that pain cannot rewrite. That is your threshold. That is your contract with your future self. Not that you will be fearless. Not that you will buy every dip. Not that you will somehow feel calm while everyone else is uneasy. Only this, that when the market becomes a machine, you will remain a steward. That when thresholds break, you will not let your character break with them. That when liquidity vanishes and volatility rises and the dollar tightens and the tape feels like a weapon, you will not volunteer your future to relieve your present emotion. If you can do that, then you do not need to guess the exact low. You only need to survive long enough to own what comes after it. And that, in markets as in life, is usually where the real compounding begins.